What a day we had in the markets with the anticipation of Nvidia releasing their earnings just after the market close, and Nvidia themselves were up 4% in the build-up, although when we look at the last week, many companies, in fact the majority in the S&P, were down quite significantly, with Nvidia down 6% on the week. Now, no surprises when we take a look at the Fear and Greed Index. Right now, we are sitting in extreme fear. We're going to take a look at Nvidia's earnings that they did release just minutes ago. And don't forget, this company has faced quite a lot of difficulties in the build up to their earnings report. At the end of January, we did see DeepSeek, which ultimately left Nvidia shedding almost 600 billion of their market cap, the biggest one-day loss in the US history. And as we can see, when looking at the last 10 biggest day single drops, Nvidia is in 8 of those, which is quite significant. We also did see Trump add more fuel to the Nvidia fire, talking about the tariffs, which has only added more pressure. But as we will come to now, Nvidia performed another double beat, and they also grew 78% on AI demand, as well as giving some very strong guidance, which is always what the market wants to see. Not just the very strong earnings per share and revenue, but as always, markets, analysts, they're all in anticipation of what to expect the next quarter. They're always forward looking. Revenue, as we can see, was a very strong beat, 39.33 billion, above expectations of 38.05. Earnings per share also coming in another double beat, 89 cents above the 84 expected. And then we can see for the next quarter, so Q1 in what is their financial year 26, they're anticipating 43 billion worth of revenue, which is again quite some way above analyst expectations of 41.78. Now bear in mind, this is year-on-year growth of around 65%, which, as we have said for quite some time, we are expecting this growth to start slowing down. Nvidia can't just continue to grow at a very rapid rate. When we compare that to the same quarter last year, it was sitting much higher at 262% on an annual basis. And we do also want to point out, today we are going to run through our updated valuation model. Now we have the full year of FY25 in terms of the free cash flow. Net income also increasing very rapidly, bringing in 22 billion for the quarter, significantly above the 12.29 billion that we saw last year. And one of the things, if we did have to pick at this, which they did disappoint, especially the analysts, they reported 73% on the gross margin for the quarter, which is down 3 points on an annual basis, although they did say that the main reason for this was newer data center products that were more complicated, more expensive, and therefore they did have to lower those margins. In terms of the revenue then for the quarter and the full year on year, given this now closes out FY25, we can see their revenue for this quarter up 78% in comparison to the prior year, and their full year revenue up 114%. Very impressive. They have managed to continue that triple digit growth rate. And one thing we have briefly touched upon, as the company does get larger and larger, it will be more difficult for them to keep up these very high growth rates, and therefore they are expecting at some point to see a slowdown. And speaking specifically about Blackwell, Nvidia CEO said 11 billion worth of the revenue was solely attributed to that in terms of the quarter, and he also says in his own words, the demand for Blackwell is amazing. In fact, we have the CFO saying that the Blackwell sales were led by large cloud service providers, which represented approximately 50% of our data center revenue, and data center is now becoming their largest income stream. It has been for some time, but now by quite a significant margin. In fact, data center businesses represent 91% of the company's total sales. Last year it sat at 83%, and the same period in 2023 at 60%. In fact, as we can see, the last sentence highlighting data center revenue has now increased about tenfold in the last 2 years. And specifically looking at that revenue figure, data center now makes up 35.6 billion, and that is an increase of 93% on an annual basis, also significantly above analyst expectations of 33.65. And one thing that we think is very interesting to note here is in terms of one of their growth categories, selling chips for cars and robots, they said 570 million in automotive sales during the quarter was in relation to this, which, as we can see, yes, a small fraction, small percentage of their total AI business, but it represents a 103% rise on a year-on-year comparative, Will be interesting as always to follow this up in the next quarter, as well as hearing commentary from the Nvidia CEO, where we do expect we will get a bit more information in the coming hours. Now, some of the headline points we can just touch upon. Record quarterly revenue near 40 billion. That is up double digit, 12% from last quarter, up 78% from last year. Data center revenue alone 35.6, up 16% from Q3, 93% from a year ago, and the record full year revenue 130.5 billion, up 114%. Now, what we do quite like to look at is the split by essential income stream. And as we've already mentioned, data center, not only the largest portion of total revenue, 35.6, total revenue 39.3, but just look at that growth on a quarter by quarter comparative. If we look at this in comparison to the same quarter last year, it was sitting at 18.4. It has been increasing and continues to increase at such a very impressive rate. And the one thing though we will point out here is one income stream that has fallen shy of analyst expectations and the previous quarters is gaming, down to 2.5 billion, the previous quarter sitting at 3.3, just something to flag. Now, for those that like to look at it in terms of their press release, well, we have the information here. The majority of this we have gone through, but we also want to show you a bit of a summary on the non-GAAP basis. In terms of their gross margins, we did highlight this one area that analysts were disappointed in, 73.5%. When we look at just the previous quarter, 75%. One thing we didn't touch upon, we did see from our notes, is that Nvidia are expecting their margins to come lower at the 70 to 71% point, and we can in fact see on a quarter by quarter basis down 1.5 percentage points, year on year down 3.2. Everything else looking strong, up double digits, revenue up 12%, operating income up 10%, bottom line and earnings per share up 10% as well. And when we look at it on a year-on-year basis, very impressive, something that we have covered, but you can see the makeup of that information. When we look at the company, what's very interesting to note, although we do anticipate more volatility when the CEO does speak shortly, it is up around 2%. When the earnings was just released, it in fact went down around 5%. So we do expect the volatility to continue over the next few hours and in fact into the market open tomorrow. As we did highlight, the market is sitting in extreme fear, so we do anticipate volatility. So just something in terms of a heads up. Nonetheless, over the last 12 months, it is up 60%. Year to date, though, it is down around 3%. Perhaps when the market does open, we could see it flat. But again, for those that are long-term shareholders who do believe in the company, they have still massively outperformed the S&P, up 23,000% over the last 10 years. Company is trading in the mid to upper end of the 52-week range. When it does open, we could see it go for another run to its all-time high. Wall Street themselves do still believe this company is a strong buy, although we do know both Seeking Alpha and Quant have given this company a hold rating. And now we are able to say the last 5 quarters, they have outperformed analyst targets, a 100% track record. And out of the next 3 quarters that we have here, they're expecting around 40 to 50% growth on an earnings per share basis. And the forward P of this company sits around 28 to 29, which you could argue looks incredibly attractive for this company. As we said, we'll run through our own valuation to give you the figures that support our thesis. And in terms of the valuation in comparison to the sector, as we've highlighted on many episodes, the sector does sit lower. You are paying a premium for this company, one we do believe it does deserve. And in terms of the last 5 years, their valuation has sat higher. Right now, it is trading significantly lower, but that is something that is supported no matter which metric you use. Price to book, price to sales, price to cash flow is trading well above the sector comparative, but actually trading a little bit lower than their own 5-year average. And as we said, they do deserve a premium, growth grade A+. As we just heard, very strong growth continuing into next year as well with the guidance. Year on year, triple digit. Moving forward, they do expect it to continue, although slow down, which is still above the sector at the mid-single digit, well above their own 5 years at 63 and 40% respectively. And they anticipate EPS to continue the upward trend, 38% over the next 3 to 5 years, above 15 and 27 from both of the comparatives. Profitability also looking good at the A+, although as we said, even though the margins does sit in the mid-70s, they are anticipating this to come down to the low 70s, 70, 71 moving forwards. Sector at 50.3, their own 5-year at 65, and bottom line also looking very strong, 56%, above 4 from the sector, above 33 from the 5-year, telling us a high quality company like Nvidia not only increases their revenue but also improves on their margin over time. That is efficiency, with a very significant amount of cash generated from operations, 59 billion, well above the 100 million of the sector and above their own 5-year of 15 billion. And they are also a leader in terms of historical performance. Over the last year, up 66%, the best performing against some of the competitors like Broadcom, Taiwan Semiconductors. Over the last 5 years, the same to be said, no one comes close. And again, over the last 10, as we highlighted, up around 24,000%, massively outperforming the S&P, but also the best performance in its class. Question is, can they continue that upwards momentum? Can they continue to outperform by quite a significant distance? Something to consider, as past performance is not reflective of the future. Now, one valuation metric we do look at is this model here, although as we said, we're running it through our updated DCF model shortly. Good thing to note is the blue tunnel is increasing over time, meaning the company is worth more, but right now it still sits even lower than the bottom end, and that is a severe undervaluation signal. And then this is also highlighted from something we discussed earlier. Their current forward P around 33-34 does sit below the 5-year average of 42.9. The other thing is this is a high quality company. Their free cash flow, something that we look at very closely, does increase over the longer term, although you can argue the majority of the growth has just happened in the most recent year, $3.46 expected over the next 12 months. Sales growth, as we just heard, another year with very strong numbers, and from a numerical perspective as well, we can see some very impressive growth, even if that is just over the last few years. Shares outstanding, whilst we didn't cover it today, and we can look at another episode when they release their investor presentation, they have been doing share buybacks over the last few years. But if you look at it from a 10-year point, they have diluted your position. But remember, if a company does outperform the S&P over the longer term, then a bit of share dilution isn't going to be a worry. ROIC, again, very, very impressive. We want a minimum of 12% for semiconductor companies, 92% on a trailing 12-month. And as we mentioned earlier, efficiencies in their margin, not only above the minimum, but also increasing over time, as we can see on the operating side. And the same to be said for the free cash flow, 50% on a trailing 12-month. That is very strong. Investors will love to see. Net debt to EBITDA, whilst we won't go through the balance sheet in detail today, what this highlights, given we want to see below 1.5, zero right across the board, number of years it would take the company to pay off all of their debt net of cash on hand. Very strong balance sheet for Nvidia over the last 10 years. Over the next 12 months, it isn't expected to take them even one day to pay off all of their debt net of cash on hand. Absolutely phenomenal to see. Now, if you've already seen this, you can move on, but this just highlights the institutional aspect at 65%, 68 billion worth of sales by the institutions over the last year, significant amount more worth of buys at 387 billion, and the same to be said, just over the most recent quarter, institutions bought nearly 3 times as much as they did sell, indicating that they are severely bullish. In terms of insider ownership at 4.23%, around 1 billion worth of sales, we get 5.5 million in fact in the most recent quarter, Q1 of 2025. And whilst we will show you here for full transparency, what we would say in our own opinion, it isn't a bearish signal for insiders to sell. Many reasons why, like personal and financial, but we get the EVP on the 6th of January, selling 36,000 shares, netting them $5.5 million. Again, information is there if you want to see. Now, before we jump into our own valuation, just to let you know, we have released our latest free weekly article. We send one free copy to your inbox every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, And on top of that, you can grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now we want to jump into our updated intrinsic value, where our price comes to $162, derived from the DCF model. Now the reason why this is updated, we did just get their full year free cash flow coming in at 60.7 billion, and we can see over the last 5 years a growth rate 153%, over the last 10 years 104%, and we have gone for 20% moving forwards. Now we have a low, medium and high, and as always these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it is for Nvidia or any others, but we have lowered the expectations in this episode to be again on the more conservative side. But you can see here we have 3 different growth rates depending on what you believe. So based on 20% with a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 162, and as we can note, 24% upside. Now, full transparency will show you at the 15% point, it does then equate to $115, downside of 12%, and for those that believe 25% to be more appropriate, $227, 73%. Now, as we said, if you do grab a copy, you can put your own numbers. For example, if you believe that 12% should be accurate, $94, or if you believe, for example, 29%, then it does say $295. Now, what we typically like to do is take the medium rate today, where we do acknowledge we have been a bit more on the conservative side, and we're not just done there, because we do like to apply a margin of safety. 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, then in today's episode, a buy around $146, and then we keep going till it's near the current trading price. So what we're saying right now, based on the updated earnings, based in fact on them growing their free cash flow at 20% over the foreseeable future, that you are getting a 20% margin of safety around $130. With Wall Street very bullish, they see 180 over the next year, with a strong buy translating to 37% upside. Now, what we'll also do in today's episode is take the 25% rate for those that actually believe 20 is way too low, and that the 25% rate will use a margin of safety, and no surprises, you will get a larger MOS if you do believe the growth is higher. In fact, for those that do see this company growing at a much faster rate at 25%, at least for the foreseeable future, you're getting a 40% MOS near $136, and Wall Street's price target does still remain untouched. As we said though, we do believe 20% a little bit more appropriate, where you are getting around 20% MOS. As always, give us your thoughts. What did you think about the earnings, and do you see this company right now as a buy, hold or sell? As always, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon, where we do cover our weekly buys and sells. We have been buying and selling given the volatility, but as always, have a great day and we'll see you all on the next one.